Hello friends, myself Akshat Garg, Manager Research Choice Wealth. Today I am accompanied by Mr. Avnish Bhatnagar, Vice President, Franklin Templeton Asset Management Company. Welcome Mr. Bhatnagar to our Q&A session.
Thank you Akshat, and greetings to all the investors of Choice Wealth, and thank you for giving us this opportunity to talk to your investors.
So starting with Mr. Bhatnagar, on 23rd April 2020, Franklin decided to close down his 6 debt mutual fund scheme, and it was very shocking and surprising. And I'm still wondering why this extreme and unprecedented move was necessary, and why did FT thought that it's in the best interest of the investors.
I thought Akshat you will start with the easy question, but you put a bouncer first up. But I recognize that the decision that we had to take on 23rd April 2020 was not an easy one.
Right.
And let me just recall, I think all of us have gone through the whole pandemic 19 crisis, and which was unprecedented, like you also called out, an unprecedented action that we had to take. So if you have to go back in time and see what happened during March of 2020, the after effects of the lockdown, I think the complete economy globally froze because of the lockdowns that happened. And in fact, while in India we did see some bit of more turmoil on the credit side, but it's not, if you have to look at globally, almost $60 billion, which is like almost 4.5 lakh crores of fixed income funds got frozen across different markets.
Okay.
So while in India we had not seen this ever in the past, but globally we've seen these kind of events which have unfolded during crisis period. So it was a tough time, and we saw a lot of action that got taken by whether it was the Federal Reserve of the US, or it was the ECB, or even back in India, you had the RBI and the government putting in a lot of liquidity and stimulus to kind of bounce back the economy. So it was a tough time where liquidity froze, and we had to take a tough choice in terms of whether we should be preserving value for our clients, or because we were getting continued redemptions on the fixed income schemes, these 6 schemes that you've been highlighting on. The choice was to continue to manage redemptions and liquidate these bonds at a discount, because liquidity was kind of frozen up at that point of time. Or we had a choice, the tough one, like I said, to say that we will preserve value, but that will obviously come at cost of liquidity. So we do acknowledge and we do recognize that there was a liquidity pain that the investors had to go through. But if you look at over the last 12 to 15 months how the events have unfolded, what we believe is the decision that we took, which we always thought was more of a liquidity issue and not a credit issue,
Right.
I think that has got validated, and now we've been able to return over 100% of money back to the investors. But we do acknowledge that it did cause a lot of liquidity issues for our investors.
Perfect. So what has been the key learnings for Franklin from this fiasco, and what are the changes now in the risk management policy?
So before I get into the learnings, and I'm sure there are quite a few, let me give you a background in terms of how these schemes were managed.
Okay.
So if you look at the history, I think each of these schemes, the 6 schemes that went under the winding up, had been in existence for anywhere between 10 years to 15 years.
Right.
And we had a consistent style of managing them in a particular way, where we used to take investments into credit space,
Right.
and typically investing in securities which were lower than AAA in terms of the rating profile as well. So that has been a consistent strategy. It did work well and had good outcomes for investors over a period of time. And like I said in my opening remarks also, we had not anticipated that something like a pandemic will hit us, which will completely freeze
Right.
the liquidity on the credit side of the market. And that's where we had to then take this tough call of kind of shutting the funds, because
Right.
liquidity was drying up. In fact, let me share an interesting fact with you on this, is how bad things were. On a particular day during the month of March, government securities, which is the most liquid part of the
Right.
fixed income market,
Right.
for 30 minutes there was no trade on GSEC.
Okay.
And this has never happened in the history that for a 30-minute period you will not see any trade on the GSEC market. So that's the background in which these schemes had to be managed, and that's the decision that we took. And having said that, there are learnings from the whole episode as well in terms of how do you do the liquidity stress testing.
Right.
Obviously, you can't do a stress test for a black swan event like that. It happened once in a century. But having said that, yes, the processes needs to be strengthened. But let me assure all our investors also that Franklin Templeton globally, we have had very, very high standards of corporate governance. We have extremely robust risk management practices globally, not just in India. And in every country, the risk practices, whichever is the most stringent, whether it is a global or the local laws, those get applied when we do our whole investment process. So yes, we do look at and recognize how do you look at the liquidity of the portfolio. But having said that, we will also be looking at how can you continue to strengthen the other processes on the risk side. So those can be the key learnings, I would say. But largely, I think if you look at the outcome that got delivered to the clients, which I said earlier also, despite having liquidity issues, we could sell most of these securities in the market, which were earlier, like I said, but less in terms of the credit rating or lower in their credit rating profile. But most of the cash got generated, we liquidated the portfolio. And today, as we speak, on the value of 23rd April 2020, we've already returned around 103% back to the investors. So we believe the outcome has been favorable. But yes, going forward, we will have learnings not just related to the pandemic, but overall process as well, which we believe we'll be able to manage these crises if they happen ever in the future in a much more efficient manner.
Perfect. So now let's come to the markets. It's red hot. The bears have totally grabbed up the space. So what advice you would like to give to the investors in this highly volatile market?
Red hot. So Akshat, I think all of us have spent enough and long time in the market. So volatility is one nature of the market. To say that is this a bear market or is this a bull market, I think there are phases in markets and all of us have lived kind of those phases in the market. Yes, globally, if you look at this point of time, because there was excess liquidity which got pumped into the market post the pandemic crisis that happened across the globe, and now most of the central banks and economies are trying to suck that liquidity out, because all of us know how inflation is rearing its heads, not just in India, globally, and US we know inflation is at a 40-year high. So these are, I think, times which we've seen in 2008 global financial crisis, also GFC, when liquidity was pumped in, and then the taper tantrum happened in 2013, and we saw similar shocks that happened across the capital markets globally. I think we are going through a very similar phase at this point of time. But if you look at markets also had an unprecedented run. So from April 2020 to maybe now, we've seen almost 124% gain that the market had. And in the last 2 months or so, the correction has been, from the peak, we've come off by 15-16% if you look at Nifty 50 index. So this volatility, I think, is part and parcel of the market. It is how you want to play. And simply, if I were to put it, we are very, very clear in our approach that you have, if you're an equity investor, you have to have a very long-term approach. That's the only way that you build and create wealth over a period of time. So you don't have to look at the market, because if I were to again borrow from what Warren Buffett says, and which again alludes to this whole volatility of the market phases, and he says that you have to be fearful when others are greedy. And you have to be greedy when others are fearful. And that's where how you will create wealth, not by staying away. It's very difficult to, or very easy to say this time it is different, and every time when market corrects you say this time it is different, but it's only time tells that whether it was different or not. So to sum up, I would say on the current markets there are two ways that you can participate. One is to say bhag low, which is bhag low, participate in the market. or bhag lo, which is like run away from the market. So if you have to say run away from the market, this is investors' choice in terms of how they want to look at markets at this point of time. But we believe this is a time where you should look at a calibrated and more staggered approach of investing and continue your systematic investments. That's how I would make the most of market volatility.
Okay. And if you see investors, when coming to making investment decisions, investor tends to follow the category or scheme that is getting the most attention. So what, according to you, is the best strategy to adopt?
Interesting question, because we do see, like I said in the previous comment also, investors do get swayed by greed and fear. And similarly, the greed comes in terms of which segment of the market or which scheme is giving me the best return and should I be participating there. And then this whole phenomena of FOMO also plays out in investors' mind, is that the fear of missing out. Somebody is making money, am I not making money? So for me, I think there are two very critical points to look at how to play the market. And it all alludes to your risk appetite to begin with. So within an equity and as an asset class, I am sure investors have higher risk appetite, but within that, investors will have moderate and conservative or very aggressive kind of a risk appetite. So, and the point is that winners do rotate.
Definitely.
So it's very difficult to say that I will stay invested in one segment of the market and that's where I will make the most money, because in the past 2 years or past 1 year, that has been the best segment of the market. And just to put things in perspective, if you look at 2020, 2021, the best performing segment was what? Mid cap and small cap.
Definitely.
But preceding to that, 2018, 2019, large caps were doing better. So we believe it's again one, up to the risk appetite, which segment of the market you should be invested in. We believe for an average moderate equity investor, you should be more in a diversified kind of a fund category rather than being very aggressive. But having said that, you can take your own tactical calls basis your risk appetite into a thematic or a mid cap or a small cap kind of markets also. But broadly, you should be in a diversified kind of a fund. That should be your approach. And the last message that I would want to give is, while we are talking about equities as an asset class at this point of time, I think the best and the simplest and the boring way of making money is actually follow your asset allocation to the T.
Definitely, indeed.
And all the research that has happened on wealth creation, behavioral finance, all of them tells us that 95% of the return actually comes from asset allocation. 5% of the return actually comes from fund selection. Or it can be 90-10. But most of the research tells us that it's 80-90% of the return actually comes from your asset allocation. So if you stick to your asset allocation within equity as an asset class, that also will help you reap your optimum returns and create wealth over a long period of time.
Okay. So if we track the journey of FT, many schemes of FT have completed 10 years and 3 of them have completed 25 years. Franklin India Flexi Cap is one of them. So can you throw some light on the scheme positioning and why it's a good long-term bet for the investors?
Great. So I think today on the equity side, Franklin Templeton manages close to 50,000 crores of assets. And like you rightly said, today two-thirds of our assets on the equity side have a track record of more than 10 years. And in fact, if you look at, you said 3, but actually there are now 5 schemes which have done more than 25 years. 4 of them are equity funds and 1 of them is a fixed income fund which we manage, have completed more than 25 years. So within that space, we believe, like I said, in the current market context as well, if you have to be invested, we believe staying in a more diversified fund, which in our case would be our Flexi Cap Fund, which is market cap agnostic. And it gives a flexibility to the fund manager, as the name suggests and the category suggests, that the fund manager can take a call when to be in large cap or how much percentage to be in a large cap fund and mid cap and small cap segment of the market. So Flexi Cap for us also has been a fund which has a more than 25 years of track record. And has a great track record. And the way we manage this fund for our investors is, and this is not just flexi cap, I would say, there are 3 broad or 4 broad variables that we kind of look at when we have to look at which companies to participate in across our different equity funds. And so we typically look at what are the compounding growth companies, which are the companies which have a more cyclical growth orientation. So we look at those companies. We look at some bit of contrarian, and so by that we still have a blend of value into the growth style. So the first 2 are more growth style parameters, but then we add this whole value by being slightly contrarian in the view. And the 4th is to look at businesses which are disruptive and innovative. So we try to play these 4 themes across our portfolio, and when we come to actual construction of the portfolio, then we typically look at the current juncture, what we are focusing on is the cyclical and mostly domestic cyclicals, not global cyclicals. We are looking at that. We are looking at companies which are benefiting from consolidation. By that, what I mean is companies that actually are benefiting from this whole shift which is happening from unorganized to organized. So the bigger and more efficient companies are gaining market share. So we continue to bet on those companies which are gaining market share because of the consolidation that is happening. And the 3rd theme that we continue to play in our stock selection is basically companies which are benefiting from tech-enabled disruptions. So people who are early adopters on technology and are leveraging on technology. So these 3 themes is what we play in FlexiCap. And not just FlexiCap, I think these are broad themes that we do across our equity portfolios. But we believe for an equity investor in current market scenario, it is best suited to be in a FlexiCap kind of a scenario where markets continue to be volatile. We've seen the premium on the mid cap and small cap segment come off quite significantly compared to large caps. So let the expert, which is the fund manager in this case, take a call for you in which segment you want to really participate. And typically the way we manage our FlexiCap strategy over the last 25 years, I would say if I were to look at from an allocation perspective, it's a 70-30 kind of an allocation. 70% typically is large cap and 25 to 30% is what we keep moving between mid and small cap. So it's a slightly, I would say, a large cap bias kind of a fund. But having said that, if you have opportunities on the mid cap, small cap post this correction, that can also go up.
So Mr. Bhatnagar, we are towards the end of the session now. Can you please share the future plan of FT in India and how you will guide investors so they can make more informed decisions?
So great, Akshat. So like I said at the beginning, Franklin Templeton in India is committed and we remain steadfast in our commitment to the India business. We've been here for last 25 years. And today I am very proud to say I have done 18 years with the company now, that we are more of a local brand with a global parent. That's how Franklin Templeton gets recognized as, and we compete amongst the top 10 players, which are all household names with bank sponsors and everybody. So we are very proud that the brand that we built, and thanks to our investors who've put that faith in Franklin Templeton to accept it as a local brand. So we remain committed. From a global perspective, again, India becomes a very important market for us because 1/4 or a quarter of our workforce, global workforce, actually is based in India. So we have a big investor service center in Hyderabad, which houses almost, like I said, close to a quarter of our total global workforce. So we remain committed. And the second reason why we are very excited about the India business at this point of time from a global parent perspective, if you look at growth outside of the developed market, I think there is no second to India and China. So if you have to continue to participate in growth economies, I think India remains a very attractive destination from that perspective. So locally, what we are trying to do at this point of time, I know, like I acknowledged at the beginning in my comments, that we did have, or we had given some pain to our investors. So we are in that process of building our trust and
Okay.
regain confidence of our investors and partners at this point of time. And to that extent, we will be communicating more with our clients as we move forward. We are more or less, we've returned the money on the fixed income fund. So from here, the next phase of growth for Franklin Templeton would be to look at areas which we can add value to our clients and our partners.
Okay.
And in that sense, we are looking at launching some new products.
Okay.
So we have some gaps on our hybrid strategy.
Okay.
So we are looking at launching some of our hybrid funds in that category to be present. And the big difference that we would bring, being a global asset manager, would be to also showcase some of our global capabilities for our Indian investors.
Okay.
And I know today with this whole overseas cap
Right.
that is there, people may not be able to participate. But as and when that opens up, we are very excited to bring a lot of our global capabilities,
Right.
whether it's on the solution side or on alternate fund side or on the multi-asset side.
Right.
So those are things that we believe that we would be able to showcase and bring as an investment option for our clients in India.
Okay.
So that's one that we are excited about. And just to sum up, I would say, reiterate those points that as an investor, I think in volatile times,
Mm-hmm.
you need to stick to your asset allocation, like I said,
Right.
and stay invested, remain committed. I think that consistency and discipline actually comes through a mutual fund route only.
Right.
So we believe mutual funds becomes the best vehicle for people to keep participating. And
Right.
if you can do this in a consistent and a staggered manner, you will continue to create long-term wealth. So that would be my closing message to our investors.
Thanks for that. So viewers, today we heard from Mr. Bhatnagar about his views on various aspects. Hope you all liked it. Mr. Bhatnagar, thank you for your time and commitment.
Thank you, Akshat, and thank you to all the Choice Wealth investors. Have a great day.
Thank you viewers for tuning in.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.